Today, February 27th, 2026, is first notice day for March COMEX silver, and the numbers are genuinely terrifying. Let me give you the situation in one sentence. As of this morning, 10,526 contracts are standing for delivery of March silver. That is 52.63 million ounces of silver that buyers have declared they want physically delivered. Against that demand, COMEX registered vaults, the only metal that can legally satisfy those contracts, hold approximately 86.13 million ounces, 52 million against 86 million. That is 61% of the entire deliverable stockpile claimed on a single first notice day. If you have ever studied how commodity markets work, you know that numbers should never exist. Delivery months are supposed to be managed events where open interest rolls down gracefully and only a small fraction of contracts ever request physical metal. What is happening right now is not that. What is happening right now is that the physical market and the paper market are in open conflict, and one of them is going to lose. To understand why today matters so much, you need to understand what happened 2 days ago. On February 25th at 12:11 Central Time, the CME Group halted all metals and natural gas trading on Globex. Their public statement said 2 words: technical issues. Natural gas came back within 50 minutes. Metals stayed dark with no restart timeline and no explanation. Silver had been trading above $91 per ounce and breaking out when the halt hit. When metals finally resumed, silver was slammed from $91 down to $84.98 across 3 consecutive selling waves. And March open interest, which had been building toward what many analysts expected to be a historically violent delivery month, collapsed by 11,356 contracts in a single day. More than 50% of delivery pressure gone, evaporated, overnight. This was not the first time. On November 27th through 28th, 2025, the CME executed a 10-hour halt, this time citing a cooling system failure. That halt also occurred on first notice day, specifically for December silver, and it also happened at a moment when a very large delivery demand was building. Reports at the time described a Chinese industrialist who had notified COMEX of intent to take delivery of 30 million ounces. After that November halt, silver did something extraordinary. It went from $53 to $121.78 over the following 60 days, a 120% rally. Then, in late December and early January, the CME hiked silver margin requirements by approximately 50% over 2 weeks, triggering forced liquidations that crashed silver from $121 back to $63. The pattern is consistent enough that it no longer looks like coincidence. Halt, deflate, margin hike, crush, recover. Repeat. No CFTC investigation has been announced. No explanation beyond technical issues has been provided for the February 25th halt. No mainstream financial outlet has asked a serious question about why the same exchange experiences emergency disruptions, exclusively when precious metals are breaking out immediately before delivery deadlines. Zero Hedge issued a caution note on February 25th that is worth quoting in spirit. Those who have been bullish since 2009 should be very careful, because there is a great deal of financial engineering happening. That warning is not bearish. It is accurate. Now, let me take you through the vault data, because this is where the story becomes structural rather than episodic. When we talk about COMEX registered silver, we are talking about metal that has been assayed, vaulted, warranted, and made available for delivery against futures contracts. This is the only metal that counts. Eligible silver, which also sits in COMEX vaults, cannot be delivered unless the owner converts it, which requires consent. Registered is the only number that matters for delivery obligations. In October 2025, registered silver stood at 167.7 million ounces. By January of 2026, it had fallen to somewhere between 113 and 127 million ounces after a brutal December delivery cycle. On February 11th, registered silver broke below 100 million ounces for the first time in recorded COMEX history. The psychological and structural significance of that breach cannot be overstated. 100 million ounces was considered an untouchable floor. It had held through every prior squeeze attempt, every delivery surge, every manipulation allegation, every crisis year going back decades. It is gone. As of today, registered silver sits at approximately 86.13 million ounces, down 49% in just 4 months. The drainage rate in early February was running at approximately 785,000 ounces per day. Seeking Alpha confirmed on February 26th that the decline in registered silver reflects metal leaving the COMEX system entirely, not reclassifying into eligible. This metal is not sitting a few rows over in a different ledger column. It is gone from the exchange ecosystem. Buyers took delivery and removed their metal. Full stop. The implications for May and July delivery cycles, which will arrive with even less inventory than March started with, have not been widely discussed in mainstream coverage, but they are the real story here. Consider what has been consumed in recent months. January and February. 2026 combined delivered 74.38 million ounces through COMEX. That is 86.4% of today's entire registered stockpile, consumed in 60 days. Full year 2025. COMEX silver deliveries totaled 474 million ounces, more than double 2024's 203 million ounces. The delivery percentage, the share of open interest that actually stands for physical rather than rolling, has been running near 98%. In a normal market, delivery rates run 2 to 5%. 98% means buyers are not trusting paper settlement. They want the metal. That behavioral shift is historic. Let us talk about what is happening in London, because the COMEX story and the LBMA story are part of the same physical market, and London is where the real tightness shows up first. Silver lease rates in London have spiked to 34.9% annualized, with intraday peaks reaching 39%. Normal silver lease rates run between 0.3 and 0.5%. You're looking at a roughly 70 to 80 times multiple over normal. When a rate spikes that dramatically, it means one thing. The people who hold physical silver are refusing to lend it. They either expect prices to be significantly higher soon, or they are concerned about counterparty risk, or both. Lease rates at 39% are not a yellow flag. They are a red flare. The exchange for physical spread, the premium for COMEX delivery over London spot, expanded from a historical average of 25 cents per ounce to over $1.10. This is the arbitrage channel that normally keeps prices aligned between the two markets. When it expands that dramatically, it means physical metal is being demanded urgently in New York, and the pipeline from London is constrained. The EFP spread normalized somewhat after the February 25th halt, which makes sense mechanically. Crushing open interest removes delivery urgency and therefore reduces the premium for near-term physical access. But the structural constraint has not changed. Metal that left London for New York over the past 4 months has not been replenished. LBMA vault data is published with a 6 to 8 week lag, which makes real-time assessment difficult. The last published figure, from end of October 2025, showed 26,255 tons in LBMA vaults, a figure that multiple analysts found inconsistent with reported flows. Silvertrade noted that the LBMA previously overstated silver holdings by approximately 3,300 tons in 2021. The estimate circulating among physical market analysts is that freely circulating London inventory, metal not earmarked for ETFs, not allocated to specific accounts, actually available for lending and sale, may be as low as 4,000 tons. That is approximately 129 million ounces, slightly more than what COMEX registered holds today. The ETF picture confirms the directional flow. SLV saw net inflows of $849.6 million over 5 days through February 27th. 3-month inflows were $1.58 billion. 1-year inflows were $3.61 billion. These are not rounding errors. These represent sustained institutional conviction that silver is underpriced and that SLV exposure is worth accumulating at scale. PSLV, the Sprott Physical Silver Trust, which holds fully allocated metal at the Royal Canadian Mint with no AP redemption mechanism, holds 217.67 million ounces. Physical coin premiums at retail dealers run 15 to 25% over spot, with multiple UK dealers reporting 2 to 3 week delivery delays on standard products. Now let us talk about something you will not find in any mainstream outlet today: Mexico. Because this is the supply shock that no one is covering properly, and it may be the most consequential new development for silver prices in 2026. Mexico is the world's largest silver-producing nation, accounting for approximately 6,300 metric tons per year, roughly 23% of global mine supply. The major silver-producing states are Zacatecas, Jalisco, Sonora, and Sinaloa. These are also, not coincidentally, the primary operating territories of Mexico's most powerful drug cartels, the Sinaloa Cartel, CJNG, and the Zetas. On February 22, 2026, U.S. forces working with Mexican military killed CJNG leader Nemesio Oseguera Cervantes, known as El Mencho, in a joint operation in Jalisco. The response was immediate and violent. Within 48 hours of the killing, retaliatory cartel violence erupted across approximately 20 Mexican states. Highways were blocked. Convoys were attacked. In January, 10 employees of Vizsla Silver were abducted from their Panuco silver project in Sinaloa. 5 were confirmed dead. The company's stock dropped 50%. Reports from silver market analysts suggest that transportation of refined silver from Mexican mines to export facilities has been effectively halted for several days, with no clear timeline for resumption. Recapio compiled reports from precious metals, traders describing CME warehouses as not being replenished with Mexican silver, with one analyst stating directly that cartel disruption is actively preventing the inventory restoration that would normally follow a delivery surge. This is not a marginal supply disruption. If Mexican silver exports are meaningfully constrained for weeks or months, the COMEX inventory drainage will accelerate rather than stabilize. The miners are not stopping production. Underground operations continue, but refined silver that cannot be transported cannot reach vaults. The gap between what is being mined and what is reaching COMEX is going to widen. China compounds the supply picture on the export side. Since January 1st, 2026, Chinese authorities require special government licensing for silver exports, with applicants needing minimum annual production capacity of 80 tons. China controls an estimated 60 to 70% of global refined silver refining capacity. These export restrictions have reportedly reduced Chinese refined silver export volumes by approximately 40% since the policy took effect. The Shanghai COMEX spread has compressed from a peak of 16% to near parity this week, partly because some previously imported crude silver has been processed and is entering the Chinese market. But that is a domestic supply response, not a Western supply replenishment. Meanwhile, the Shanghai Futures Exchange has taken its own extraordinary steps. In February, SHFE restricted 23 accounts for exceeding position limits in silver. SHFE reduced delivery allocations to 0 for investors without approved hedging quotas. The SGE adjusted margin ratios on February 24th. These are not normal market operations. These are the actions of an exchange that is managing physical supply tightness through administrative controls rather than price discovery. And then there is geopolitics on top of all of this. This morning, Pakistan declared open war on Afghanistan. Defense Minister Khawaja Asif confirmed that Pakistani air forces struck Kabul, Kandahar, and Paktika province after Taliban forces launched large-scale attacks against Pakistani military positions overnight. Pakistan claims 274 Taliban fighters killed. The United Nations issued a statement of deep concern. Neither Pakistan nor Afghanistan is a major silver producer, but an active declared war between nuclear-armed neighbors in Central Asia is precisely the kind of risk event that drives institutional flows into hard assets. Gold is already at $5,178. Silver at $90 in this environment is arguably still cheap. Simultaneously, United States-Iran nuclear talks wrapped in Geneva on February 26th without a deal. Both sides agreed on guiding principles, and technical talks are scheduled to resume in Vienna next week. However, the U.S. has deployed 2 carrier battle groups to the Persian Gulf region, and CENTCOM has briefed the White House on military options. A breakdown of talks leading to military action would affect Saudi oil facilities, Persian Gulf shipping, and global energy prices in ways that would strongly support precious metals. What does the speculative positioning data tell us about who is actually driving this market? The CFTC Commitments of Traders report as of February 17th shows COMEX silver total open interest at 131,496 contracts. Non-commercial speculative net longs sit at 24,003 contracts, approximately 120 million ounces. Managed money's net long position has collapsed 77.7% year over year, falling from 54,415 contracts in February 2025 to just 12,121 today. That is the critical insight that most people miss when they try to understand this rally. Silver did not go from $30 to $121 because hedge funds piled into futures. The speculative community is actually deeply underweight relative to historical patterns. The price move was driven by physical delivery demand, by industrialists, by sovereign wealth funds, by institutions taking metal out of the exchange system and not bringing it back. Sprott Money's analysis confirms that persistent backwardation in the silver futures curve, which first appeared on October 2, 2025, and has held since, is a physical market signal rather than a paper speculation signal. You do not get sustained backwardation, where near-term contracts trade at premiums to longer-dated ones from futures speculation. You get it when real buyers need real metal right now and are willing to pay more than for deferred delivery. The supply deficit data from the Silver Institute confirms the structural backdrop. 2026 is projected to be the 6th consecutive year of global silver supply deficit. The Institute estimates a shortfall of 67 million ounces this year. P. Morgan's estimate is considerably more dramatic at 245 million ounces, a difference that reflects disagreement about the pace of industrial demand growth, particularly from solar and AI data center applications. The cumulative 5-year deficit since 2021 exceeds 800 million ounces. That is roughly an entire year of global mine production that has been consumed without being replaced. Mine supply is expected to grow just 1% to approximately 820 million ounces in 2026. Recycling is projected to increase 7%. Neither number comes close to closing an 800 million ounce structural hole. Samsung reportedly secured an exclusive 2-year offtake agreement with a major silver mine earlier this month, bypassing exchanges entirely. That is a leading indicator of what sophisticated industrial consumers are beginning to understand. If you need silver for manufacturing in 2 years, you cannot rely on exchanges to provide it at any price. You need to lock it up now, directly from the source, before it is gone. Price forecasts for the next 2 to 4 weeks span a wide range, but the center of gravity is clear. J.P. Morgan's official average for 2026 is $81 per ounce. Citigroup projected $100 by March, with upside to $110 in the second half. B in Crypto Technical Analysis suggests a daily close above $91 to $92 triggers a breakout toward $100 by mid-March. Silvertrade targets a retest of the January all-time high at $121.78, drawing a direct comparison to the post-November halt, 120% rally. The Kitco Silver Survey found 57% of retail investors expect silver to trade above $100 at some point in 2026. The critical technical level to watch is $91 to $92 on the upside and $82 to $84, the 50-day moving average, on the downside. A break above 92 with conviction opens the path to triple digits. A break below 82 signals that the post-halt selling pressure has more room, with the next support at $75 to $78. The futures curve is in backwardation on both COMEX and SHFE as of today, which is a structural bullish signal that overrides short-term technical uncertainty. Let me tell you what the next 30 days actually mean, because this is where I want to leave you with something concrete rather than just data. The CME's successful compression of March open interest from over 85,000 contracts to 10,526 did not solve the problem. It postponed it. Here's the math. COMEX registered inventory is at 86.13 million ounces today and draining at approximately 785,000 ounces per day. That is before March deliveries begin eating into the pile. If delivery rates continue at anywhere near the 98% pace we have seen in recent months, March alone could demand another 40 to 50 million ounces. The vault would exit March somewhere between 35 and 50 million ounces, the lowest registered inventory in modern history by a very wide margin. May 1st notice day is 63 days away. For the May contract to avoid the same crisis scenario that unfolded in February and March, COMEX vaults need to be substantially restocked before then. That restocking requires silver to flow from somewhere. From Mexico, which is currently under cartel siege, from London, which has already been shipping metal west for months, from China, which has restricted exports. There is no obvious large-scale source of replenishment on the immediate horizon. This does not mean COMEX defaults. COMEX has mechanisms beyond outright delivery: cash settlement, EFP offers, force majeure provisions. It has used these before. The more likely scenario is a continuation of the pattern we have seen. Exchange interventions that reduce delivery pressure at the cost of credibility, followed by price rallies as physical scarcity reasserts itself. The question is not whether the physical market ultimately wins. The question is how many times and at what cost the paper market can delay the reckoning. There is one more thing I want to say directly, because this channel is about honest analysis and not about pumping anyone's bags. Everything I have described today is real and documented. The inventory drain is real. The lease rates are real. The Mexican supply disruption is real. The geopolitical stress is real. The exchange halt happened and the price was crushed and no adequate explanation has been provided. These are facts, not narratives. What is also true is that this market has delivered the most violent price swings in its history over the past 90 days. From $71 to $121 to $63 to $90. Anyone who told you to buy at $120 and held experienced a 48% drawdown in a matter of weeks. The structural bull case does not protect you from manufactured volatility designed to shake out weak hands. If you are in this market, you need position sizing that survives the swings, and you need to be honest with yourself about your time horizon. The physical thesis plays out over months and years, not days and weeks. For the people holding physical silver in allocated accounts, in safe deposit boxes, in your home, today's report is fundamentally positive. The metal you hold is physically scarce. The institutions that understand this are accumulating. The industrial users who need it are locking up supply off-market. The vaults are draining and not refilling. You are on the right side of a structural trade. The noise around that trade is going to be extreme, and you're going to need patience. But the underlying reality is not changing. The supply is finite. The demand is accelerating. And paper promises about silver delivery are becoming less credible by the month. Currency Archive. That is what this channel is for. Documenting the moments in financial history where the data tells you something that the mainstream narrative refuses to acknowledge. Today, February 27th, 2026, is one of those moments. First notice day for March silver. 61% of registered inventory claimed on day 1 of the delivery period. A world on fire from Kabul to Sinaloa to Tehran. Vaults draining at nearly 800,000 ounces per day. And the exchange that is supposed to provide neutral price discovery has now used 2 trading halts in 3 months to manage delivery pressure with no regulatory consequence. Like this video if you want to see more of this kind of analysis. And if you are new here, welcome. This channel exists because there are people who want to understand what is actually happening, not what they are told is happening, not what makes financial media comfortable to discuss. What is actually, measurably, documentably happening in the real world of commodities, money, and power. That is what we do here. See you in the next one. Let me go deeper on something that almost no one in mainstream finance has reported. And it connects the ETF world directly to the physical crisis in a way that makes the entire situation considerably more alarming. SLV, the iShares Silver Trust, the world's largest silver ETF, saw its short interest hit a record 73.55 million shares in early February 2026. That is 12.8% of outstanding shares sold short. To short SLV, a broker must locate shares to borrow. In a physically backed ETF, shorting at scale does not create new physical silver. It creates paper claims on top of paper claims on top of physical metal. When the short interest on SLV hits 73 million shares, what the market is really saying is that an enormous number of participants are betting against silver exposure, or hedging against it, through a vehicle that purports to be backed one-to-one by physical metal. The subsequent 38% collapse in SLV short interest to 45.79 million shares tells you something equally important. Those shorts were being covered. 43% fewer people are willing to be short SLV today than were willing to be short 3 weeks ago. Short covering of that magnitude at the ETF level, happening simultaneously with COMEX vault drainage and record lease rates in London, confirms that the paper market participants who understood the situation best were rapidly repositioning from short to flat or long. The options market on SLV is even more extraordinary. On February 25th alone, the day of the CME halt, SLV options volume hit 61 million shares in notional exposure, equivalent to approximately $4.9 billion in a single trading session. Implied volatility on SLV ran at 99 to 103% annualized, compared to 37% historical realized volatility. That is a volatility premium of roughly 280% over realized. In options pricing, when implied volatility trades at that kind of multiple over realized, it means the options market is pricing in the possibility of price moves that are dramatically larger than what has historically occurred. The people pricing those options, the market-making firms, the prop desks, the authorized participants, know something. They are pricing silver like it could move 50% in either direction in the next 60 to 90 days. That is not normal commodity volatility. That is a market preparing for a discontinuous event. Let me address the macro backdrop, because silver does not trade in a vacuum, and the monetary environment right now is as supportive as it has been in years. The dollar index sits at 97.78 today, down 9.2% over the past 12 months. The 10-year Treasury yield has fallen to 4%, its lowest level in approximately 3 months, as markets price in 2 Federal Reserve rate cuts before year-end. Real yields, the 10-year Treasury minus inflation expectations, have dropped from 1.98% to 1.72% in recent weeks. Every one of those directional moves is tailwind for silver. The relationship between real yields and silver is one of the most consistent in all of commodity finance. When real yields fall, the opportunity cost of holding silver, which pays no income, decreases. When real yields fall and the dollar weakens simultaneously, as they are right now, silver typically responds with outsized moves relative to gold. The gold-silver ratio has already compressed from above 100 in early 2024 to 57.78 today, but historical precedent during dollar weakness cycles suggests the ratio can compress further, toward 35 to 45, which at current gold prices of $5,178 would imply silver prices of $115 to $148 per ounce. January producer price index data released this morning was expected to show moderation from December's hot 3.0% print. Softer PPI would reinforce the case for Fed cuts and extend the real yield compression already underway. The PCE data, the Fed's preferred inflation measure, is due next week. Precious metals traders will be watching both releases carefully because a hot inflation print combined with a weakening economy creates the stagflation scenario that has historically been the most explosive environment for silver and gold. Now let me tell you about something that I believe is genuinely underreported in the silver community, and that is the psychological and behavioral dimension of what is happening to retail silver investors right now. Because understanding the behavior of the retail participant is crucial to understanding where the price goes next. The people who bought silver at $121 on January 29th, the all-time high, watched their position drop 48% in approximately 2 weeks. That is not a normal investment loss. That is a margin call level drawdown for anyone using leverage, and an emotionally devastating loss for anyone who had conviction in the bull thesis. The speed and severity of the crash from $121 to $63 was specifically designed, whether organically or deliberately, to shake out maximum conviction. Every stop loss below $90, below $80, below $70 was hit in rapid succession. The people who survived that crash and held their physical metal are, by definition, the people with the deepest conviction and the longest time horizons. They are also the people who will be most resistant to the next shakeout. What matters now is what happened after the crash. Silver recovered from $63 to $90, a 43% recovery, in approximately 3 weeks. Every person who panic sold physical silver during the crash has already watched the market recover to within striking distance of the pre-crash levels. The psychological effect of that recovery on the remaining holders is reinforcement of conviction. They held through a 48% crash, and they were right to hold. The next shakeout, if one comes, will need to be more severe or more sustained to produce the same volume of forced selling. The retail silver holder community has, in a strange way, been hardened by the crash. This matters for market structure because physical silver purchases by retail participants do not easily reverse. When you buy a physical silver coin or bar and put it in your safe, you do not sell it because silver drops 15%. You need a compelling reason and a convenient mechanism to liquidate. The people who have survived the 2026 volatility are unlikely to be net sellers unless prices fall dramatically below their cost basis for a sustained period. They are a structural source of demand overhang on any dip. Now, I want to give you something specific about the May contract situation, because this is the forward-looking story that matters most. The March contract will settle over the next 31 days. Some of those 10,526 standing contracts will be for immediate delivery. Others will be spread across March trading days. Let us assume, conservatively, that 50% of the current standing OI takes delivery in March, approximately 26 million ounces. That leaves registered inventory at approximately 60 million ounces entering April. May 1st notice day falls on April 29th. Between now and then, the only way COMEX restocks registered silver is if large holders of eligible silver consent to convert it, or if new metal is shipped from London, Mexico, or other sources. Given Mexican supply disruptions, London lease rates at 35%, and Chinese export restrictions, reducing refined supply by 40%, the replenishment outlook is poor. If registered inventory reaches April with 60 million ounces, and the May delivery cycle demands anything close to what March demanded, which is a reasonable assumption given the unchanged structural factors, the exchange will face a registered inventory crisis that cannot be managed through a trading halt alone. The historical precedent for what happens when a commodity exchange faces genuine delivery failure is instructive and sobering. In March 1980, COMEX responded to the Hunt Brothers Silver Corner by declaring trading could only occur in liquidation-only mode, meaning new long positions could not be opened. Only existing long positions could be sold. This regulation change had destroyed the ability of new buyers to enter the market and allowed the shorts to cover without competition. Silver crashed from $49.45 to $10.80 in a matter of weeks. The exchange intervened to protect the short side. The Hunts went bankrupt. The shorts survived. In 2011, when silver approached $50 per ounce in a rally driven by quantitative easing and inflation fears, the CME executed 5 consecutive margin hikes in 9 days. Silver crashed 30% in approximately 2 weeks and never recovered to $50 in the subsequent decade. Again, the tool was the exchange's margin-setting authority, applied asymmetrically, always raising margins when prices rise, never when they fall, to create forced selling that relieved pressure on concentrated short positions. The February 25, 2026 halt and its aftermath follows this established playbook. The difference this time, and this is the critical structural difference, is the physical vault inventory. In 1980 and 2011, COMEX registered silver was plentiful. The exchange was intervening to prevent a price surge, not to prevent a genuine delivery failure. Today, the vaults are at their lowest levels in recorded history. The exchange can manage open interest through halts and margin hikes. It cannot conjure physical silver that does not exist. When registered inventory falls far enough, and on the current trajectory, that may be the story of May or July 2026, the exchange's administrative tools will be insufficient to prevent a genuine disruption. What that disruption looks like is the open question. Possible outcomes include cash settlement imposed on delivery holders, with premiums large enough to incentivize acceptance. Emergency rule changes redefining deliverable specifications, massive EFP transfers moving delivery obligations to London, or, in a more extreme scenario, declared force majeure and a halt to silver futures trading on COMEX entirely. Each of these outcomes would have profound implications for silver's price in physical markets, because if COMEX cannot deliver, physical silver prices decouple from futures prices, potentially dramatically. Several analysts have pointed out that PSLV already trades at a small premium to NAV that reflects exactly this perception. Investors are willing to pay extra for silver that is genuinely, verifiably allocated and cannot be rehypothecated. Here is the thing that I keep coming back to, and I want to say it plainly. None of this is certain. COMEX has been declared dead by silver bulls in 2010, 2015, 2021, and multiple years in between. The exchange has consistently found ways to manage delivery pressure through mechanisms that retail investors cannot fully see or understand. The pattern of halts, margin hikes, and cash settlement offers is not new. What is new is the vault inventory level, the delivery rate, and the simultaneous supply disruptions from multiple geographies. Whether these factors are finally sufficient to overwhelm the exchange's management capacity is genuinely unknown. I am not telling you this is the definitive breaking point. I am telling you that this is the most structurally stressed environment silver has ever been in, based on data that is publicly available and verifiable, and that the next 30 days will tell us more than the previous 10 years about whether the physical market can force the paper market to reprice. On the industrial demand side, the numbers that will define silver's long-run floor price are still accelerating. Solar photovoltaic manufacturing now accounts for approximately 20% of annual silver demand, up from 4% in 2015. Each gigawatt of solar capacity requires approximately 50 tons of silver. Global solar installations are projected at 700 gigawatts in 2026, up from 600 in 2025. The AI data center buildout requires silver-intensive connectors, circuit boards, and cooling systems at scale. The EV transition requires silver in charging infrastructure, battery management systems, and autonomous driving sensors. None of these demand drivers are discretionary or price-sensitive in the short run. Manufacturers do not have silver substitutes at commercial scale. This structural industrial demand floor is new in silver's history and represents a qualitatively different market than existed in any prior cycle. This is why analysts like Citigroup's commodity team are projecting $100 per ounce as a near-term target rather than a multi-year aspiration. They are not projecting it based on speculation or monetary panic. They are projecting it based on a supply-demand model that does not balance at current prices. Silver at $90 in a market running 800 million ounce cumulative deficits, with vaults at record lows, supply disruptions across the two largest producing countries, and industrial demand compounding at double-digit annual rates, is not expensive by any reasonable measure.